Another important thing that we need to discuss is our financial reporting concepts. These are things that are part of GAAP, realizing that GAAP, again, is generally accepted accounting principles. They are formulated by the FASB, and which is the Financial Accounting Standards Board. Very recently, the Financial Accounting Standards Board, FASB, completed a first phase of a project where they are trying to develop a conceptual framework for accounting. What they stated with their primary objective was to provide useful information to investors and creditors for making decisions about providing capital to companies. Now, in looking at this, there are two fundamental qualities that FASB has outlined as useful information. And useful information should be relevant, and it also should show faithful representation. Now, with relevance, what this is looking at is, would it make a difference in a business decision? So if you're looking at a couple of pennies off and things like that, that's not going to make a big difference. So that is not going to be something that is relevant. It also considers things relevant if it provides information that has predictive value. So if it provides accurate expectations about the future, if it has confirmatory value, so if it confirms or corrects prior expectations, those are items that are going to be relevant items. Another word that is used in the relevance world is this materiality. Now, materiality is very, very company specific. Because for a very, very small company, $100 might be very material for what they're looking at. For a multi-million-dollar company, however, $100 doesn't matter. It is not going to change or make a difference in a business decision. So we do have to look at the company specifically to see what size that company is, really to find out what is going on with that particular company. An item is material whenever the size of that item is likely to influence the decision for an investor or creditor. If it's not likely to actually make a difference and influence a change, then it's not going to be material. The other side of it is faithful representation. For faithful representation, it means that information has been accurately depicted, and it shows what really has happened. When we look at this, it needs to be complete. So we need to make sure that we are listing everything out and everything is complete in it. It needs to be neutral. So it cannot be biased toward one position or another. And the last thing that faithful representation needs to show is that it is free from error. So we need to make sure that this is free from error. And that's what faithful representation really is looking at. Other qualities that FASB has stated are enhancing qualities that are useful for information is they need to show comparability, they need to show consistency, they need to be verifiable, they need to be timely, and it needs to be understandable. So when we're looking at these words and we're looking at comparability, this looks at the results when different companies use the same accounting principles. So what we want to make sure is that if two companies are pretty much doing the same thing, that a person can go in and do the accounting and they come up with the same information. They need to be comparable between the companies, so we are comparing apples and apples. And that's really what FASB is trying to get at with generally accepted accounting principles, is we want everybody on the same playing field. The next one is consistency. And this is just within that particular company. And what it's stating is that the company is going to use the same accounting principles and methods from one year to the next. When we look at methods, we're going to get into more of this once we hit chapter 5, 6, 9, and 10. We're really going to get into some different methods. We have different methods for inventory. We'll be looking at LIFO, FIFO, weighted average. What that's stating is that the company chooses to use the LIFO inventory valuation, that year after year after year, they actually have to use that same valuation. If they're looking at percentage of sales as the way that they are looking at bad debt expense, they have to do it the same way to account for it and be consistent in what they're doing. The next one is verifiability. For information to be verifiable, if independent observers using the same methods will obtain the same results. The next one is timeliness. Now, if we need to make sure we are getting our accounting information out in a timely manner. I mean, it can be 100% correct, but if it takes us a whole year to get the information out, then we don't really, there's not the benefit out there for people to be able to use it. So we do need to make sure that it does come out in a very, very timely manner, and that it's available for decision makers before it loses its capacity to actually influence them. And the last one is understandability. And if understandability is present, it needs to be in a clear and concise fashion so that reasonably informed users can interpret and comprehend that data. And so that's really what those enhancing qualities are. Some of the assumptions that we have in accounting is we have our monetary unit assumption. This is where it requires that only those things that can be expressed in money are included in the accounting records. And so that's when we look at different transactions, we see if they involve a monetary value. Again, if we have just hired a secretary, that is no monetary value until she actually works for us. Hiring her is no transaction. So the monetary unit assumption comes into play and says that we only record things that have a monetary value. We have the economic entity assumption. This states that every economic entity can be separately identified and accounted for. This is where we are looking at the fact that the business is separate from its owners. And the accounting for the business needs to be kept separate from anything that is personal on those owners' sides. We have the time period assumption. This is where it states the life of a business can be divided into artificial time periods. The most common time period that we use is the year. So that's one of the things that we look at, but it can be monthly, quarterly, or also other artificial time periods. One that we haven't looked at yet this semester is the going concern assumption. The going concern assumption states that the business will remain in operation for the foreseeable future. We don't see any reason why this business is going to fail. If we do see that the business is possibly going to fail, then it would not have going concern. But if we think that the business is going to continue on, there's no real issues with this business, then that will pass that going concern assumption. Other things that we look at here are principles. And generally accepted accounting principles do look at some different things. We have 2 measurement principles that are used with generally accepted accounting principles. The first one is historical cost. This is the one that we use the most. And what it does is it dictates that companies record their assets at their cost. This is something that we can verify. We know what we paid for things. So we will use that measurement principle to stay verifiable and to stay accurate with our information. So if we purchase land for $30,000, it continues to be reported for $30,000. Even if it goes up, if it goes down in value, it's reported at historical cost. Now, fair value principle. This indicates that assets and liabilities should be reported at their fair value. We use this for a couple of different things. We will use it for accounts receivable. Sometimes people don't pay their bills, and so that has to be written off. We can use it also for investments, stuff that we can look at on the stock market. If it's traded on the stock market, we know what the fair market value is, and that's what we record it at. So those are things that we'd use fair value for. Other principles that we see and that we have already discussed, one of which is the revenue recognition principle, and this requires that companies recognize revenue in the accounting period in which the performance obligation is satisfied. So what that's saying is when we have performed the service or we have delivered the goods, if we're looking at retail, we have met our recognition principle and it has to be recorded in revenue. The next one is that matching principle. It's also known as the expense recognition principle. And what that is doing is it says that we have to match our expenses with the revenues. All right, so it's matching expenses with the same time period that the revenues have been earned. So if we use supplies during the month of May, we need to match that expense with the month of May. The last one that you see here is the full disclosure principle, which is going to be discussed in a later chapter near the end of the semester. And it requires that companies disclose all circumstances and events that would make a difference to financial statement users. And so that is what we're looking at with full disclosure principle. We do have different cost constraints with some of these principles. When we try to provide information, we want to be as relevant, as reliable, and all of that is that we can be. But sometimes providing information is very, very costly. So we do have to weigh out the cost versus what the benefits are going to be. If the costs are more than what it's going to benefit, then we're not going to do it. If our costs are less than the benefit, then we actually will make sure that we implement all of these procedures. And so this is just some of the information that you will see that deals with what FASB is doing, conceptual framework, the assumptions, the principles, and all of that information that you just kind of want to go over and make sure that you're really clear on, because these are principles that we will be looking at for the rest of this semester.